Josh. Good morning. I know that you are not a political strategist, nor am I asking you to be one, but at least as somebody who manages money for a living, might you agree with that thesis? That as we showed our viewers in 2000 with the contested election, the S&P 500 fell nearly 6% in a matter of about 4 weeks. If the reality of a contested election now is reduced slightly, the chances of, do you agree that would make the financial markets a little more stable?
Yeah, I would agree completely. I think that, on Thursday, before the prospect of the president having coronavirus was a reality, I think the betting markets, which I look at because there's money on the line and they kind of condense everything into one number, it was about a 62% chance of a Biden win with the president, being diagnosed that, there was some lift there. So it went to maybe 64, 65. So yes, I think the idea that it's a more convincing win, if that's the case, I think that is helpful. And you saw that on Friday, the market's reaction to Trump's diagnosis was, I would say, really muted. Very little rise in the VIX. The market was down, but the market had been on a good run for a little bit there. So I would agree completely.
Because we have to separate the two. Obviously, a lot of concern about the president, the first lady, and everybody else who has afflicted their health. But the market doesn't look at that type of thing. The market looks at outcomes, probabilities, right, and the level of risk. And what the market appears to be saying, and I was looking at the betting markets as well over the weekend, Josh, not only the presidential race, where Biden is now at about 67 cents or 67%, but the Senate race as well. You had Goldman Sachs saying last week that the chance of a Democratic sweep is growing. They view that as actually equity market positive, not because they're making some kind of political statement, but they're simply saying the market would then know what it's going to get and what the playing field of regulation may look like a little more clearly. You focus on utilities, an incredibly regulated segment of the market.
Right, exactly. And I think to your point, the market doesn't love uncertainty. And the flip side of that is something like utilities where, there's always a little bit of uncertainty, but it's a lot more predictable, a lot less business risk. There's visibility and predictability. So I think that in a time like this, to the extent that the market doesn't like uncertainty, granted there's less of it perhaps, yeah, I think utilities are an interesting place to look.
So when you look at a WEC Energy and Atmos, a Southern company, yeah, utilities, pretty high dividends, you're not saying buy those necessarily because they're defensive and you're nervous and those are places to hide. You actually view them as realistic capital appreciation stories.
We do, yeah. I mean, when we talk about utilities, it is hard, admittedly, to get people's attention because utilities are not exciting, and I'm not going to try to convince you that they are, but I don't think that making money in the market needs to be exciting. It doesn't need to be Tesla exciting. And I think when you look at the underlying fundamentals of utilities, especially now, you have yields that are about 150 basis points over the S&P's yield. You get earnings growth anywhere from about 5 to 8% across the board, dividend growth of about the same. And you mentioned WEC, which is a holding in our Hennessy Gas Utility Fund. Earnings have compounded at about a 5 or 6% annual rate in the last few years, and dividend rate at about, the dividend payment has compounded at about 14%. So I would say that's exciting, especially because there's visibility into the future there.
Shepard Smith here. Thanks for watching CNBC on YouTube.